Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And I'm going to get into a Q&A episode today. I promised to share another case study episode with you next week on Tuesday. So I'll sprinkle a few more of the case study episodes in there. Of course, if you have any more questions, I've got heaps of questions, but if you have any questions, don't hesitate to send them to me at questions@investopoly.com.au. I'll be sure to get to them. If I always try to look for a theme, a generic kind of theme, issue, idea, strategy, consideration within these questions so everyone can, learn a little bit more, hopefully. So, if you can make them lean that way rather than being really specific, that'd be great. But either or, I'll have a go at answering them. Okay, so let's get into it. The first question is from Simon. Simon writes, I love the podcast. I'm an accountant by background and apply a lot of your investment philosophies. Your book is a great reference. Thanks so much, Simon. I have 3 investment properties in Brisbane and have done really well and paid out my primary place of residence home loan. I'm in a strong position to buy another property. However, the property prices versus rental yields aren't making any sense to me currently in the Brisbane and even in the Melbourne market. For example, or the example of the investment property you own in Brisbane, which owes you over $1.5 million returning $670 a week, would have a huge negative cash flow. Can you therefore demonstrate how you think this property will achieve an internal rate of return 11% over the long run? The detail behind the before-tax cash flow shortfall and after-tax cash flow and projected gains would be interesting to understand. For an A-grade quality property, do you have a rule of thumb on what the maximum holding costs you would be prepared to incur relative to asset value? Keep up the great work. Okay, this is a really great question, Stephen. And it is a really good one, and it's hard to sort of get your head around the numbers because cash flow is really ascertainable. Like, it's here and now. We know exactly what a property is going to cost us. Getting our head around compounding capital growth and the likelihood of a property being a certain value 10, 20, 30 years from now, that's really difficult to do. And I've done a bit of reading about this in terms of just psychologically, what is it in human brains that make it really difficult to estimate how figures compound, right? So if I said to you, $100, 10% return, you keep that for 30 years, what's the rough balance? Anyone that has a sort of leaning, some people can do that in their head probably, but I certainly can't. But some people that have, an affinity with numbers still can't really work that out or conceptualize it in their head. And that's kind of the challenge. Anyway, I need to do some more reading on it and then kind of solidify it, hopefully, into something that listeners of the podcast can learn. But that's the issue really that I find with investing in property. Let's go back to the Brisbane property that I used as an example in that blog. Actually, what I've done is pulled up what do the numbers look like for the 24 financial year for that exact property. So let's use some actual numbers. So that property cost pre-tax about $36,000. There's about $4,000 of depreciation per year, and assuming top marginal tax rate 47%, that property is going to cost about $17,000 after tax to hold. Okay, so then the question is, is that worthwhile? Well, if I hold it for 10 years, that's 170 grand. Conceptually, what I like to think about is, will that property be worth twice the value in 10-ish years from now? And, we bought that property 2 or 3 years ago, I think, from memory. I should probably pull up this information or at least commit it to memory. But when I bought the property, that was my view. I formed the view, this is the type of asset I think is going to be worth twice as much in 10 years from now. So let's go back to the original purchase price, which I think was $1.45 million. So I'm going to get about $1.5 million of equity growth over 10 years, and it's cost me $170,000 after tax in terms of cash flow to hold the property over that period of time. So I don't know about you, Simon, but even in that short period of time, it works for me. That's an attractive investment because really what I've done is put $170,000 in and I've accumulated $1.5 million of equity, albeit that's pre-CGT. So I've achieved a pretty significant return on my investment. Now, going back to your question about, how much, and if you allow me, I'll paraphrase it a little bit, how much cash flow are you willing to stomach Well, it's really a case of perspective, Simon. It's really interesting. I've spoken about before in this podcast that one of my mentors, to his mind, an investment property, should cost, you should probably spend $3 or $4 million. In fact, literally, I was having a conversation with him last year, and he was saying to me, Stuart, you should go and buy a property in Sydney with water views, spend $7 or $8 million on that asset. Anyway, it's an interesting conversation. He's bang on, by the way, right? So forget about the getting your head around those numbers. This mentor has done it himself and generated tens of millions of dollars of equity by taking that approach. So Simon, the answer is you want to make sure that your internal rate of return is going to be significant. I think double digits. If you're borrowing to invest in property, that's what you should be aiming to do. When I calculate internal rate of return 11%, I would have been conservative with my numbers. It's likely, given the trajectory of Brisbane, it's likely to be better than that, I think. But that's what you really want to look at, and it's really about forming a view on the capital growth. But I'm kind of happy to lose a lot of money on an investment if I'm absolutely convinced the capital value is going to be there in the future. And I've got some other larger investments that are kind of similar to that. But it's a bit of an art and a bit of a science. And it's really about trying to put yourself in your position in 15, 20 years from now and look back and think about, what should have you done, and make sure you don't regret not doing that today. And, it takes a little bit of guts and internal fortitude to sort of make that work, because to sign up for a negative cash flow, significant negative cash flow, you're losing money from day one. You've got to be really confident that it's going to work. And that's why I think, getting a really good, trustworthy, experienced buyer's agent in your corner to make sure you get the asset selection right, making sure you've got the investment strategy right. I mean, all these are all critical things that I think go to minimizing the risk. But a low rental yield can mean that, you're at the end of a growth cycle, or it could mean that, you're getting a lot of land and there's not much improvements on that property. So I would appreciate that if we looked at rental yields in Brisbane 7 years ago compared to today, the rental yields should have compressed. And that's sort of saying because, if I go back a couple of weeks in my talking about growth cycles, the data is pretty strong. The growth cycles last about 10 years. Well, Brisbane's more than 5.5 years into its growth cycle. So, of course, during that time, yields will compress. I would argue in Melbourne, though, you should see an expansion of yields to some degree because rents have been growing, but property values haven't. Although if you're looking at an asset that with a very low rental yield, then you probably want to be convinced it's a high land value asset. And as I've said in the podcast before, buy that asset and then make some improvements to improve the yield. So it's really all about the growth when you first buy the asset, and then worry about the yield after you buy it and try and minimize that cash flow as much as possible, which is exactly what we did to the Brisbane property in terms of completing some cosmetic renovations. Great question, Simon. Thank you very much for asking. I hope that answer makes sense. It's funny, I just read these questions in order, and the next question is about the property in Queensland. That's pretty funny. So the next question is from Tim. Tim writes, I have a property in Brisbane with a development approval to split it from 1 into 2 lots. Similar to the property you spoke about in Indooroopilly, that's all land value and the house is not the greatest, but with some renovations would rent up for $650, $750 per week. My goal is to knock it down and build 2 dwellings. Obviously, this would increase the rent and the depreciation would play a role, being about $60,000 a year for 2 dwellings combined. Rent of around $1,000 to $1,200 a week. My question is, if all the growth is going to come from land value, am I better off doing that renovation now and getting the higher rents, or letting it grow for another 20 years and doing the split then? Great podcast. Keep it coming. So, Tim, it's a great question, and it's good because I've got a couple of insights. Because naturally, I don't know if I mentioned it in the podcast, the property we've got in Indooroopilly is actually on 2 titles, but the Brisbane City Council, I don't know if it's changed recently, only allows you to have 1 dwelling on that. I can foresee that potentially changing in the future, in which case then I could potentially build 2 dwellings on the lot that I have. I might be able to do that now, I'm not even sure. But anyway, that was something that I've sort of kept at the back of my mind. The best and highest use, though, probably of the property that I own is to build a family home on it. So I've kind of considered similar to what you're suggesting, Tim, which is really make some significant improvements to the asset to improve its income profile and also its tax profile, particularly from a depreciation perspective, and improve the return that way versus not doing that. So I've thought about that deeply and I've actually done the numbers around it. So let's park that observation. And then the next observation is I have actually done some work, which I'll be sharing in this podcast this year, actually probably in the next few months, where I've looked at some developments clients have done. Some of these, I think from memory, in the 90s, maybe late 90s, early 2000s, but held these assets for a long period of time. Maybe it's early 2000s. Anyway, they held these assets for a long period of time. And I've actually gone back and completed an analysis, pulled out all the information from tax returns and so forth to work out the internal rate of return. Because this is something that's been in my head for a long time in terms of how do you weigh up? It's really difficult for Tim to kind of weigh up, okay, I get the higher rent, but then I've got a higher debt because I've put more capital into the property in terms of making improvements, but then I get some depreciation benefits. But then I've sort of changed the nature of the asset because now I've got an asset that's got more improvements than land value. So will that change the capital growth rate? But then you overlay across that, well, construction costs have changed a lot, unusually, certainly over the last 4 or 5 years through that COVID period. But, construction costs do change. So how do you sort of weigh all that up? Anyway, I don't really want to give away the conclusion without getting into the episode, but the conclusion is it's not that great. And then if you factor in, well, it used to be great, I should say, but it's not that great today. And if you factor in those higher construction costs, it's likely not to yield a great result for you. And I'm pretty happy with the cash flow profile of the property that I've got. So I'm not unhappy putting some more money into it. And I will improve it. I probably will improve it before I sell it. That probably makes a lot of sense to me. But after all the analysis that I did, I concluded that I'm just going to leave that asset. And if something happens over the next couple of decades where I think this property is really becoming a pain in the neck just because it's really dilapidated or it really needs, we're spending good money after bad, or if some planning rules change or whatever, yeah, sure, I might look at the opportunity of doing it. But otherwise, generally the plan is just to leave it as is and make those improvements before I sell. Another really great question, Tim. Thank you. Okay, next question is from Kobe. Kobe writes, trying to wrap, pun intended, my head around the capital gains tax implications of transitioning from accumulation into pension phase when I retire. From what I can find, the majority of funds, industry and retail funds, have to sell down assets and then repurchase into a pension account for individuals. If so, wouldn't this trigger significant capital gains tax, even if I'm only paying 10%? Surely this could cost a lot of money on higher balances. I can only find a couple of options that allow in-specie transfer of assets like a self-managed super fund and wrap accounts. But wouldn't changing from, say, Vanguard into a wrap during accumulation trigger capital gains tax as well? Just hoping you can clarify if this is a big cost to super balance at pension phase on a transition into retirement. So Kobe, it's right. Any change of trustee is a capital gains tax event. So if you switch from Vanguard into a wrap or you switch from Vanguard into, I don't know, UniSuper or something like that, that's going to be a capital gains tax event. But if it's a unitized fund like Vanguard or like UniSuper, and like most funds, the capital gains tax is already incorporated into the daily unit price. So, it's already impacted your balance, right? And it does so on a daily basis. Whether you're buying or selling, they of course have to make an allowance for any tax on unrealized gains on any investments, because if you leave, that liability then rests with the remaining members, and that's not a fair outcome. So the question then is, how do you avoid it? Well, yeah, you can in-specie transfer investments. Obviously, you don't have to make any sort of changes to investments when you switch from accumulation to pension in a self-managed super fund. That's really just a trustee minute to do that. And then the accountant needs to allocate that sort of amount to a pension account. So nothing actually physically changes in a self-managed super fund. In a wrap, those investments can be easily transferred or converted, I should say, and the capital gains tax disappears because the trustee doesn't change. All right, so that's where you can sort of save on capital gains tax. You're right that the capital gains tax could be significant. It's going to depend on how long were you in that ownership structure for. So how long have you been in the self-managed super super fund or wrap, and what is your balance and how often have you changed or made changes to your investments over that time. But arguably, you could invest in an index fund that provides most of its return in capital growth, like IVV, the S&P 500 iShares ETF. You're only going to get about 2% of income off that. And if you look over the last 10 years, you would have got probably 10% compounding capital growth. So if you invested in that asset, you're going to have more than doubled your original investment in unrealized gains. And I guess, the unrealized liability in super would be 10% of that amount. And that's what you're going to save. So if you're only 5 years away from retirement and you have not a huge balance, it's probably not a huge problem. If you are 20 today, or let's say 20 or 30, you're young, you've got a long runway until you're going to access super, and you expect to have a pretty high income over that period of time, then you're probably miles in front by having a product that allows you to avoid capital gains tax. I just don't think, you just got to be careful though, right? With a lot of these sorts of decisions, it's multifaceted, and you've got to be careful not to be too focused on just one element. I mean, it's a little bit like trying to make an investment just to maximize your tax return each year. That doesn't necessarily make sense. You've got to look at, what are the fees you're going to pay? What are the returns are going to be? If you're going to do something that's more bespoke, do you have to pay for financial advice because you've got to then include that? So I think it's one of many things that people need to consider when where they're going to invest their super, but I wouldn't be overly fixated on capital gains tax necessarily. You need to balance out kind of all those considerations. Okay, next question is from someone that wants to remain anonymous. I've always committed to answering every question, so listeners knew that I wasn't cherry picking and that people knew that their question would be answered. I don't know if I can answer this one, unfortunately. The person's asking for me to calculate the internal rate of return on their investments. Well, I certainly can't do that. And certainly partly because they haven't provided enough information, but mainly because that's not what I'm doing here in this podcast, is providing free services. And the next question is, can I buy a home? And the person appears to be, asset rich, income poor, although I don't really know the full. Oh yeah, maybe I do know the full asset position. Anyway, the person's really in a situation where their lengthy explanation is that they don't really have a lot of serviceability and capacity to be able to borrow. And in that situation, the avenues to continue to build wealth are limited to really shuffling the deck chairs, really, which is, you're going to have to make friends with selling some assets and reallocating capital elsewhere. Unfortunately, borrowing against assets when you don't have a traditional job is going to be challenging to do, but I can't really offer much more than that. I'm sorry about that. Okay, next question is from Josh. Pretty long question. Let me try and give you a summary. He's 40, his wife's 37. They've got one child. Wife does not work. Obviously looking after the baby. They're planning on having a second child. They've got two properties. One's an investment property that they bought for about $365 in 2017 in Adelaide, so just before the sort of growth cycle, if you like. They estimate that property is now worth maybe around 700. So it's done really well, doubled over that very, relatively short period of time of only 5-ish years, as I said, just before the growth cycle. Perfect timing. It's in Richmond in Adelaide, 5 k's from the CBD, a semi-detached 2-bedroom, 2-bath house on 500 square metres of land. They live outside of Adelaide, however, in a sort of regional location, and they've got a house where they think it's worth $550,000 with $240,000 of debt. I should have said that the investment property is sort of neutral, positive cash flow, as you kind of expect after that level of growth. And Josh's question is, what they want to eventually move back into Adelaide at some point in the next 10-ish or so years. And what do they really do in order to not get priced out of the market? What do they do financially now in order to position themselves to do that? So Josh, a couple of weeks ago, I spoke about cycles and so forth. If you look at Adelaide, it's 5.5 years into a growth cycle. Growth cycles tend to last about 10 years. Maybe it doesn't last 10 years in Adelaide, but maybe there's some more growth. But I mean, if I bought a property in 2017 for $365, and if I think that property is now worth $700,000, I don't know about you, but I'm not selling it. Like, why would I sell an asset like that? I'm going to pay a lot of capital gains tax. If I need to reinvest, I'm going to pay stamp duty again. And there's no real signs of Adelaide market going backwards. I mean, it will slow down as the growth cycle gets towards the end. The growth does sort of start to level off. But, arguably, look at the data that I looked at. I mean, you'd potentially conclude that there's still a little bit of steam left in the Adelaide market. Not getting priced out of a particular capital city location, though, is an important planning consideration. And typically what I like to do, and I've spoken about this in the podcast before, is that I like to go and buy the desired long-term family home as soon as possible, just because prices tend to trend higher over time and we need to pay for that asset with after-tax dollars. So, to be able to go and buy something in, say, 10 years' time, I need to sell a lot of assets, pay a lot of capital gains tax potentially, in order then to be able to go and buy an asset with no debt or with less debt. And that's not an economical way of really doing it. But I find that I do talk about in the podcast about playing the long game. So this is kind of to some degree counter to that. But, you just got to try and make the best property decisions, best financial decisions with the information that you know today. And you just don't know how markets are going to behave. So the questions that you're faced with today then, Josh, is, do you sell that investment property? Well, no, I don't think so. Do you sell your home? Well, you've only got $240,000 non-tax deductible debt there. I don't think that's such a huge deal and potential impact on cash flow. If you had a huge home loan, I would say, well, maybe that's going to suck out all your cash flow. So I wouldn't bother doing that. I think that the bigger question is, what do you do in, say, 3 to 5 years' time, when you feel like that Adelaide market is the end of its growth cycle? That's the big question, I guess. And what you haven't alluded to really in your question is, how much would that forever home cost now? I'm going to take a guess and say probably north of $1 million. And so that's difficult to kind of conceptualize, where you'll be in 10 years' time, what your income will look like, what will markets do over that time. If you invest in the share market, what would that do over that time? So that's why I'm saying you've just got to kind of have an eye to that long-term decision, but really face the key decisions today. And I wouldn't sell the investment property because I think there's probably most likely a little bit more steam left in the Adelaide market. It's done well for you already, so it's demonstrated the propensity to provide capital growth if the market continues to drive that growth. Based on recent history, it looks like that property will pick that growth up. Keep plowing as much money into your home loan as possible. Maybe you start investing in other shares, given that in other investments like shares, I should say, given the investment property is not really costing you any money. So if you have surplus cash flow, do that. Maybe don't make any additional super contributions, partly because you're 20 years or so away from retirement, but mostly because want to do this home upgrade. So building wealth outside of super, maybe in your wife's name, might be another thing you can do. And then it's really about reviewing your options in 3 to 5 years' time, and then working out, well, what do you do? Do you take your money and run in terms of get rid of the investment property and kind of crystallize that return and find somewhere else to invest that money before you move back into Adelaide, or you do something else? I'm not sure. But a bit of a sort of ramble and long-winded explanation from myself there, Josh. But really, it's an important decision. And, I think it's just about trying to balance, what you know today and focus on those decisions with certainly an eye to what the future looks like. And I'm always reluctant to sell an asset that's working unless there's something particular about that asset or location that suggests that future returns are not going to be, even near-term returns are not going to be anywhere near what past returns have been. Okay, next question is from Graham. Graham writes, firstly, thanks for the podcast. Really enjoy the analysis of the numbers. Graham, I enjoy putting the numbers together. I hope that shows across the podcast. Hopefully you can answer this easy question, but something I've been very confused about. I currently earn $150,000 a year, which puts me in the marginal tax rate of 37%. However, the actual tax payable on $150,000 is just a little less than $37,000, which gives me an average tax rate of about 24.6%. Which percentage figure, marginal average, should I use to make different investment decisions? As a practical example, if I contribute to super, my contributions are taxed at 15%, which is significantly less than my marginal tax rate of 37%, but not as big a difference compared to my average tax rate of 24.6%. Another example is I was looking at an investment bond. My understanding is these are taxed within the bond at a company tax rate of 30%. This would be lower than my marginal tax rate, but higher than my average tax rate. When working with clients, do you differentiate between marginal average tax rates? Great to hear your thoughts, Graham. Really great question, and can understand why you're confused. You really look at the marginal tax rate for most decisions, not all, but most. And that's because, for example, if I'm thinking about what to do with that marginal income, so you earn $150,000. Let's say you've got some surplus investable cash flow of $10,000 a year. So what do I do with that $10,000? Well, if I contribute it into super, my taxable income is $10,000 lower. And so it's best then to look at what tax I have saved, which is the 37%, versus the tax paid, which is 15% inside super. So you're 17% better off by making those super contributions. Similarly, if you're talking about the investment bond scenario where all income and capital gains are taxed at 30%, realized capital gains taxed at 30% inside the bond, the same sort of thing. If you invest in a bond in your personal name and you earn another $10,000, that's going to be taxed at 37%. So that marginal tax rate is the key differentiator there. Where we would look at average tax rates is where we are able to distribute income and where we were able to own assets. So, for example, if I've got a family unit and I know they spend $150,000 a year, for instance, so we need a lot of income in our personal name to pay for living expenses, then what I would like to do is distribute to individuals and keep their average tax rate as low as possible, and certainly not more than 30%, because if it's more than 30%, then I hopefully can distribute or divert some income into a company to cap my tax rate at 30%. So that's when we would look at average tax rates, but when making investment decisions, it's primarily looking at what your marginal tax rate is, because that's the marginal outcome of your investment decisions. Just a quick one on investment bonds while I'm here. I know, Graham, your question doesn't relate to it per se. One of the attractions to investment bonds is that if you invest the money and you hold that money for 10 years, you're not going to pay any capital gains on the unrealized capital gains on that investment. And that's kind of an attraction for some people thinking, well, that's good. That's a capital gains tax saving. And as Graham alluded to, the income remains inside the company. So it's taxed at a flat 30%. It doesn't impact your personal income position or tax position, I should say. And that's certainly a positive too. And that would be a positive in Graham's scenario. But quite often people put a lot of weight on no capital gains tax after 10 years. My problem with it though is, what is the realistic outcome here? For example, is the investor going to sell the entire investment in 10 years' time? I know they can because there's no capital gains tax, but is that what they want to do? Because what most people would do is build up an investment portfolio while they're working and then gradually potentially divest from that investment portfolio over time in retirement. And as a result, they're spreading their capital gains tax over many years. They're potentially not paying any capital gains tax anyway in the long run. If they sell massive chunks of that portfolio, of course they do. And in that situation, yes, a investment bond could be beneficial. Of course, the investment bonds attract fees as well, so you then need to think about the drag on returns from fees. But I just wanted to mention it just because it's something that I think some people go into these investment bonds thinking there's massive tax savings, but I'm not sure they're always going to materialize. Okay, next question is from someone that wants to be called JS. So, of course, I'll call him JS. JS writes, first of all, thank you for your exceptional contribution to educating millions of Australians in building wealth. I'm one of the beneficiaries of your work. I've listened to all the Investopoly episodes. Thank you. Thanks, JS. I'm glad you enjoyed them, and I'm glad you've invested all that time listening to all the episodes. Hopefully they've got better over the years, and hopefully they continue to get better. That's my goal anyway. Okay, so JS writes, I have a home in Brisbane, 22 kilometres away from the CBD, albeit in a very good suburb. I also have 3 investment properties, all houses, which are also 22 to 30 Ks away from the Brisbane CBD. I bought the investment properties between 2016 and 2019. So, almost bang on before the growth cycle. Fantastic timing there, JS. All of them have almost doubled in value, ranging from $850 to $950 each. My home is worth, without debt, $1.2 million. So, it's not hard to work out that JS is in an excellent financial position. And time in the market is useful, of course, but timing in this circumstances has worked a treat for him. And that's why I keep talking about growth cycles in my podcast. Anyway, JS continues, right, I'm thinking about selling my home and the 3 investment properties in outer Brisbane and use the proceeds to buy a good family home close to the CBD in the 5 to 7K radius. I realise that I'll pay a significant amount of capital gains tax as I'm in the top tax bracket on the sale of the 3 investment properties, but I know I'm putting all the proceeds into buying a family home close to the city in a good location suburb. Is this a sound strategy? Do you see any issues with this? JS, on the face of it, I really like the strategy. And the reason I like the strategy is if we think about 20 years from now, I think quality will be the most important attribute in terms of what capital growth you might experience. And it's really trying to own an asset where the top 20%, the wealthiest 20% of Australians desire that asset. And the reason I say the top 20% is because wealth inequality, unfortunately, from a social perspective, it's terrible, but from a investment perspective, it's a trend that we can certainly invest behind. That is that wealth inequality just gets worse. We've seen that over many, many decades in lots of developed countries, and the system is really in the top 20% wealthiest favour, really. And that's just going to get worse and worse. And those top 20%, they're going to have greater income growth, greater capacity, greater sources and multiple sources of wealth. And they're the ones going to be able to push the prices further. The only way that property, 20 to 30 Ks out from the CBD, the only way that that can continue to grow is that household incomes continue to grow. And, I just don't really see that happening, or that there's a massive and successful infrastructure spend in Australia that means living 30 k's away from the CBD isn't such a big deal. Like it's similar to, parts of Europe. If you really live anywhere in France, you're not anywhere, but most places, your proximity to amenities is not that much different to living in a big city. Well, that's probably never going to happen in Australia either. JS has, as I said, bought before a growth cycle. Really, from the end of 2018, the Brisbane market really kicked off. And when we look at the growth that he's experienced in those properties, we go, wow, that's amazing. Why would you ever sell those properties? But if you consider that Brisbane went through a flat cycle between, all of 2011 right through almost the end of 2018. And so if we then spread that growth over that period of time, so what have those properties done since the end of 2010, for instance? So the last 14 years, I think that puts the growth in better perspective, and it's not as, and not as wonderful. And I think that's really what longer term you could potentially expect, or maybe even less growth than that. And for those reasons, although it does trigger a lot of capital gains tax, but that's the reason you invest, right, is to create these opportunities. And that's the reason why we save, is that hopefully we're trying to create a better life for ourselves, which means having financial security, which means being able to live in a great area, owning the home that we live in, all these sorts of things. And so sometimes it is necessary. I've seen people do it, divest of all their assets, put it all into their own occupy home, and I haven't ever seen a situation where they've lived to regret that decision. So not only do I think that's going to be a good financial decision because you're leveling up in quality and you're putting all that money into a asset that's going to be capital gains tax free, but I also think and know from my experience that it's likely to have some immeasurable positive impact on your standard of living as well, in terms of amenities and so forth and locality. So I really like the strategy, JS, in isolation from what you've told me. I'm certainly not negative on that. I think there's probably a little bit more growth in Brisbane, by the way. So if JS is selling these investment properties, I'm not saying that they've hit their peak. Maybe they continue to grow, but and I'm really looking at this as a 20-year decision rather than, will JS be better off over the next couple of years? Okay, next question is from Eric. I'll probably squeeze in one last question, and I won't read all positive comments out. I'm starting to feel a little bit self-indulgent when I do that, but I do want to acknowledge the really positive feedback that people take the time to share. So that's the only reason I do that. But thanks, Eric, for your kind feedback. Anyway, Eric writes, I have some questions regarding a share portfolio. We're in our late 30s with a combined income of 400,000, me 300, my wife 100,000. My plan is to maximize super contributions every year, but also build a share portfolio outside of super given our age. We have invested about 30,000 or so far in the share market into ETFs and direct stocks under our personal names in a combined account. Questions. 1. Would you recommend continuing to add to the current portfolio under our personal names or create another portfolio under a family trust or company? We plan to hold this for the longer term, at least till age 60. And number 2, which platforms do you recommend for share investing? We're currently using Self Wealth, but I'm thinking about something more automated. Are you familiar with Stockspot or Pearler? Would you have any recommendations for these? Thanks very much for sharing your thoughts and wisdom. So, great question, Eric. So, should you do it in joint names? Well, you're in the highest marginal tax rate, so I certainly wouldn't be doing it in joint names or your name. I guess if I was going to build a share portfolio outside super, the things that I would weigh up is, do I put it in your wife's name only, given she's on $100,000, so her marginal tax rate is 32%, or do I put it in a family trust? If I put it in a family trust, who am I going to distribute income to? Do you have children? Are those children getting close to being adult children, so 18, in which case I can distribute to them, particularly if they're going to uni or whatever, they're probably not going to earn a lot of money and I can save some tax then. If I'm just distributing to your wife, then there's no real, at least no immediate advantage putting it in a family trust. Putting it in a company wouldn't be so bad because your wife's marginal tax rate is 32%. In a company, you're going to pay 30%. So it's not a big difference, but the benefit is you get a credit for the tax that you pay, and that credit continues to be accounted for. So really, if you are in your late 30s, let's say in 20 years' time, let's say even better, in 15 years' time, you want to say, well, you know what? I don't want to work anymore. I can't draw on super because I'm not 60 yet, but I'll pay myself a dividend out of the company. You can pay yourself a dividend and you'll get a credit for all the tax that you've paid over the years, which means that then you can spread that tax burden over many, many years and potentially get all that tax back. So I would probably either go put the portfolio in your wife's name or company. I just don't know enough about your situation to give you a definitive answer. Of course, any information in this podcast is general information. It's not specific financial or tax advice, but I would go and speak to a registered tax agent, Eric, and consider those two options. I think a company name kind of start leading towards that, unless you've got other family members that you can distribute income to, even self-funded retiree parents or siblings, whatever it might be, then a family trust could work. But good thinking about this now, right? Because you're just in the start of the journey. Often we meet clients and they might already have a significant portfolio. In fact, actually, one of the advisors and I were talking about one yesterday, and we'd love to move the investment, we'd love to change the investments, but it would just trigger too much capital gains tax. And if it was in a different environment, we could make some significant improvements to how his investments are allocated and therefore the future performance. So well done, Eric. It's well done everyone on thinking about this, and hopefully this sort of information helps. Platforms. Okay, this is why we need Campbell more involved in the podcast. Different generation, younger generation, more au fait with all these apps and different products, and it really is. I mean, it's a pretty dynamic market. But I was listening to a podcast about Pearler, or the person, actually, I think it was an interview with someone that runs that business, I think. And I was really impressed with the functionality that Pearler does in terms of dollar cost averaging, automating investing, all those sorts of things. So I don't know about the fees. I imagine they're pretty competitive, but that really resonated with me. And I think, Eric, if I was in your position, I might think about that. Just check whether they do accounts in family trusts or company names, because that could be a decider as well. I'm not sure if they do. but I don't know enough about it, so I can't give you any really useful information. But, from what I heard in terms of what Pearler can do, it seemed like a fantastic investment product. And even the platforms can't do what Pearler does. So, but, anyway, that's another podcast for another day. Anyway, as you can see, I'm trying to add some more answers into these Q&A episodes. I hope they're not too long because I do like to keep it sort of closer to 30 minutes. But thank you very much for listening. If you've got any more questions, you can send them to questions@investopoly.com.au. And until tomorrow, and I've got a great episode tomorrow on analysis of borrowing to invest in property inside super. So I'm really looking forward to sharing that with you. And until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.